We are less than 90 minutes to go from the CPI report. That's a key inflation report that investors are going to be watching to assess the outlook for the Fed's rate hiking campaign. Steve Leisman joins us right now with more. Steve, there have been some pretty huge expectations that this number is not going to be hot.
Yeah, it's going to solve all our problems, Becky. That's what people are looking for anyway. But the battle here between the Fed and the markets, that's what it is, about higher or lower rates. It heats up today. Have the CPI come in the street looking for headlines CPI to actually decline. And it's unclear how much any of this is going to matter to really move Fed officials. Here's the expectations. Down 0.1% on the headline. It had been up 0.1. That's the force of goods prices declining. 6.5% is the expected year over year, down from 7.1. Core CPI seen up a little hotter, and that'll be watched very closely, up 0.3%, with the year over year again falling to 5.7% as higher rates in the past 12 months drop out of the equation here. The key to the report is going to be the tension between you have declining fuel and goods prices, still high rents and service inflation, along with stubbornly rising food prices. Close attention going to be paid to that preferred indicator of Fed Chair Jay Powell we've been talking about. He focuses on services, takes out food and energy and housing, looking for that part of the equation that is most moved by labor and wages. The Fed futures market, two different ways it can react here. Let's look at what they might be. The January-February meeting currently trades with about a 75% probability of a 25 basis point hike and a 25% probability of a 50. A hotter number could turn the market towards pricing in a 50. Cooler number could mean 25, and some folks have speculated it could mean the end of the rate hike cycle here. A hotter number, though, could push up the peak rate, currently at 4.94, back towards 5 and above where it's been in the past. Even reduce expectations. You see that right there on the right part of your chart there. Expectations for cuts or rate cuts later this year. Long commentary from the folks over at Mizuho, but I think it's worth it. Disinflation is underway, they say, but the market and policy debate going forward will be characterized by disagreement over preferred inflation indicators. When and at what level prices on the goods side are likely to level off. And this is important here. What degree of slack in the labor market is required to see a greater moderation in core services inflation? Even after this number, the question is going to remain if the Fed is really data dependent, or is it headed towards that 5% rate to stay there, whatever the data may say, with its decision tied at least as much to the jobs market, wage data, as it is the inflation report. Becky?
Yeah, and maybe not being swayed by a few good numbers, maybe being concerned what happens if it gets colder, if energy prices go back up, also waiting to see how it plays out in wages in particular.
I think that's right, Becky. I had thought, I don't know, when we had a conversation probably 6 months ago, the Fed would need 3 reports. This would be really the third good reporter, especially when you look at the goods or the core side of it, if it comes out the way the street is expecting. That year-over-year rate is coming down. But I think the Fed says, hey, it's a 5.7% year-over-year core rate. My goal is 2. I can't be cutting rates here. I still need to be hiking. The question becomes how much it's incorporating the lagged effects of what it's going to do, or what it's already done, the balance sheet reduction that it's been going on, and, of course, just the slowing of the economy that we keep hearing about in a variety of different metrics.
Steve, thank you.